Federal Reserve left its key interest rate unchanged at its meeting yesterday, but some members of the Federal Reserve Board appeared in favor of raising rates in the face of inflation, despite the president's push for the Fed to cut rates. For more on what rates staying put means for consumers, we're joined by financial advisor Jason Matthews. Jason, thank you for joining us. There's a lot of politics and talking about what should happen, but let's talk about the real impact right now on consumers, specifically mortgages, savings account for retirees, credit cards, that type of thing. We'll start with mortgages. Fixed rate mortgages, of course, won't change, but new borrowers, what is, if you wanted to buy a house right now and take out a mortgage, what does that mean, the rate remaining unchanged mean for them?
Great question. So if you look at what happened to the 30-year bond rates yesterday, they actually climbed and went up. So that dimensionally means that mortgages can actually go at higher rates right now than what we're currently seeing, because it's all based off of 10-year treasuries and 30-year treasury rates, and those actually climbed up after the meetings yesterday.
So you're not getting a cheaper rate at this point.
No. Don't count on it in the short term that you're going to get cheaper rates. It's not happening.
So what should you do? Should you wait it out if you want to look for a house right now and take a mortgage out?
Just think this is the new norm. Those COVID loans are never coming back of 4% or below. This is the new norm. You got to live and adjust. If you can find a house that's affordable for you, great. And then hopefully down the road you can refinance for a lower rate.
Yeah. What could conceivably, if you buy one for 6.5% right now, what if it goes down to 6%? Is that 6% or maybe below at 5.9%? Like, what is it? What is the typical reduction that you would say, okay, I need to reduce because I can significantly take money off my payment?
If you see it go down 50 basis points, 75 basis points, then you can refinance at that point.
That's helpful. Not anything like less than that, like just a few.
No, because you still have to pay for the costs to even do that loan, so it has to balance itself out.
All right, let's talk a little bit about credit cards now. What this means: variable interest rate credit cards on existing cards will stay roughly where they are rather than climbing higher or dropping. Is that the understanding of what's happening here?
Correct. So this is a time where the Feds are putting on pause. They increase rates like 3 of the people wanted on the board to do. So this is the time to say, hey, maybe you might raise rates higher down the road. So in the meantime, let me go ahead and get my house in order with these credit cards and reduce that credit card debt because they're so high. But they could climb up higher if more and more members think that inflation is going to continue.
Okay, so that is what's important now. If you have a lot of credit card debt, consider figuring out how to get that debt down right now, because who knows? When's the next meeting happening?
In September.
September. So in a couple of months, it could conceivably go up. What could we be looking at if it went up? Like, what's normal that we've seen historically here that we should be aware of in the back of our minds?
And right now, with this new federal president, this is new times, not giving us any warnings like we have previously seen. So we actually don't know what's going to happen next. So he said you have to watch how the economic data, and he didn't tell us what data that they're watching. So this is a time where we actually don't know what's going to happen next.
Wow. So you're just saying just knock it out right now if you can,
Correct.
Or at least pay attention to knocking it out as much as you can right now.
Correct. Either by getting a 0% transferring to a 0% interest credit card, or look at getting a personal loan, which is cheaper than your credit card rates are right now.
Gotcha. All right, let's talk about savings accounts and CDs as well. How does this rate being left the same affect your savings and CDs?
Those are the winners from this.
Okay.
Because as interest rates are higher, that means you're going to get more higher rate of return on your money. That is actually beating out inflation. So people right now who have money in 10-year treasuries or long-term bonds, those interest rates climbed yesterday. So people who are retirees or have savings account, this is actually a win for them, because higher the interest rates, the higher more money you get in the bank compared to when rates are cut back.
For the lay right now, high yield savings account, what is that exactly? So if you want to put some money,
so you're saying you're right now, those high yield savings account, you're seeing 3.25%, 3.5%.
Yeah.
Treasuries right now, you're seeing up to 4.5%. It depends on what rates are those as well.
That's a quarterly, annually?
Annually.
So you'll be getting 4% of your money possibly on that on those type of high yield savings accounts.
Correct.
That's where you can make some money in all of this.
Exactly.
All right, fantastic. Anything else we should know? We only have a few seconds left.
No, I would say this right now, retirees are a winner from this, because as bond rates go up, that means higher fixed income and safe money is doing better than having that additional risk that they normally would take.
All right, we'll check in with you again soon. Good advice all around. So there's some good news, some bad news, depending on what side you're on.
Exactly.
Sure. All right. Jason Matthews from financial advisor from Jason Matthews. We really appreciate you stopping by and giving us this advice today.
No problem.
All right. Sal, we'll send it back.